All right, well, today we're going to go over how to backtest manually properly. This week, I've been working with Adrian from experttradingprogrammers.com, and we've partnered. He has a product called the Expert Manual Backtester, and this is something that I used extensively a while ago. I'll show you some of the details of how I used it in the type of manual backtesting that I had done before. This in no way replaces Bloodhound, but it's a really incredible tool for doing the type of discretionary backtesting. For instance, with trend channels, fibs, Elliott wave, some of those different things that you can't necessarily program inside of Bloodhound. This tool enables you to basically log the trades efficiently very quickly and record all of your stats. It gives you a lot better statistics than just typical statistic analyzer. So what I want to do is we'll go through a bunch of examples in CL. Okay, I'll start off showing you kind of what I went through in putting together the system that I'm currently trading, and how difficult that was, how long it took. And had I have had a tool like this, it would have been much, much easier. So we'll go over some of that, and then we'll actually use this expert manual backtester to mark up, let's say, the past 10 days from May 1st in CL. So what I'll do is basically I have a bunch of different rules written out in a notepad, and we'll mark up the charts. I'm only going to use 4 charts rather than the typical 6 or 7 charts that we use in the trading room, and focus on some of the smaller setups. So what I've been wanting to do, basically the way that I've been trading is looking for the larger corrections, looking for some of those larger moves so that I could participate in the next major move within the trend. You know, typically over 100, 150 ticks. So that's what I had been focused on in the past. And what I've been wanting to do is the type of backtesting necessary to prove out how efficient, how rewarding it would be if I were to focus on some of these smaller setups, some of the intraday little corrections on like a 5-minute or a 2-minute chart. So this is some of the stuff that I've been wanting to do. And I've been doing that for the past couple of days, and it's really looking pretty incredible. So before we get into all of that, let me show you the required disclaimer. Obviously, don't trade with money you cannot afford to lose. And I am going to show you some simulated results, but those were results in a sim account trading, forward, not a back test. Actually, trading in a sim account. And I'll show you some live results as well, and my results from today. And then I want to get into marking up the charts for proving out a system that I think we're going to be using here pretty soon in the trading room. So obviously this is with the benefit of hindsight, the test that we're going to do today manually for the manual back test. So just keep that in mind. So currently, I was able to bank about 1,200 today. This is a live account, and I'm currently long gold. I had bought the low here. I think that was Tuesday afternoon, yeah. And then I held all day yesterday, and I ended up buying one more right here, actually. And I'm still holding that one. I took one off right in here. Let's see if I can show that. So this is kind of the way that I've been trading, looking for, those much larger moves. See, this is where I added yesterday before the close, and then took one off right here. So this is really what I've been typically after, those larger moves. And what I've been wanting to do is put together a small set of rules, not too many rules, but enough rules to be able to tell, whether you're following a trading plan or not. Obviously, the more rules that you have, typically the worse the performance will be due to degrees of freedom and whatnot. But obviously, you do need to have some set of rules that you can test and measure your performance against. So what I've been trying to do the past few days is figure out, what's the minimum set of rules that I could put together to take advantage of some of these smaller corrections that we see occur all day long. I mark them up in the trading room, but I rarely ever participate in those because I'm after the larger moves, like I've been saying. So I've done that here with just a small little set of rules. And again, this is in no way to try and replace Bloodhound or Blackbird. As a matter of fact, let me just kind of tell you where we're at right now, because I'm sure a lot of you are curious. We've been in development mode here for well over a year, I guess, but really heavily the past several months. And it's finally coming together. I think our next major webinar for showcasing everything inside of Bloodhound and Blackbird will be June 22nd. And we'll be doing that with Shark Indicators. So we are getting everything to the point to where we'll be able to program out as much as possible in a sort of semi-automated fashion. I still, I have to retain some level of discretion because of the market structure and the way that I look at, corrective waves and impulse waves and stuff like that. So I'll still retain that level of discretion, but we'll be able to automate out the precise rules for trade management, for example, kind of a minimum set of requirements for getting into the trade, for instance, requiring what we call a churn bar, which is a high density, very high volume per range bar. I'm not going to go into the details of all of the methods and indicators that we use today, but so what we're doing with this tool, this manual backtesting tool, is to basically be able to mark up our entries and exits. This is it right here, using a set of rules that we can't exactly completely program out. Okay, so with this, we can retain that level of discretion and put together as many rules as we can, and then go bar by bar, marking up the entries and exits where we would have placed the trade. So that's what I want to do with you today. And at the end, we have partnered with Adrian, and we're basically working as an affiliate. So he's allowed us to market his product. And today, well, through Sunday, we're going to give a 10% discount on it. Okay, so we'll go over that at the end, and this will be essentially the one and only discount that we'll be able to give on it. All right, so let's go through. We'll start at May 1st. Let me kind of go over the rules a little bit first. So what I'm going to do, rather than going for the larger setups like I was saying, which typically occur on the 20-minute or the hourly chart, I'm just going to use 4 charts here, a 1500 tick, a 300 tick, a 5-minute, and a 1-minute chart. And I'm only going to trade from 5:30 a.m. to 11 a.m. Okay, I'm going to require at least one area sloping in favor of the trade. So when I'm talking about an area, I mean this. So this would be a trend channel, median line, upper median line, etc. So I would be requiring at least one trend line, channel line, median line, whatever, sloping in favor of the trade. And then at least one other area acting as an area of confluence. So at least 2 areas, one sloping in favor of the trade. And then to confirm the entry, I'm going to require a high density climax bar. I'll explain that a little bit when we get to that point. Or a climax bar on a 1-minute chart with high volume per second on the smaller tick chart. Okay, or a churn bar on either 4 of the charts. Any of the charts, the 1-minute, the 300 tick, the 5-minute, or the 1500 tick. And I'll go over what a churn bar is and all of that. So typically when we're talking about looking for a correction, we're talking about identifying the trend, first of all, and trend is a function of the time frame that you're on, obviously. You might be in a downtrend on an hourly chart, but in an uptrend on the 5 minute. So it really just depends on how you want to define trend. But for instance, what I'm talking about with a correction is identifying the impulse move. So for instance here, if we're starting from this low right here on the 5 minute chart, we've been moving up pretty strong, and then we have a sideways overlapping move right here. That looks like a typical kind of an ABC correction. You don't have to know Elliott wave. You don't have to really know too much about patterns. You just have to, be able to identify what is the strong move in which direction, and then the correction out of that strong move. You typically want to trace out within a channel or within a set of median lines, and then run into an area that's upsloping, typically on one of the larger charts. But in this case, today I'm trying to prove out allowing some of these smaller setups. So I'll allow the area sloping in favor of the trade on the actual chart that the correction is occurring on. So for instance, the high is here, right? And then we come down, wave 1 down, 2 up, and then 3 down. So this would be the entire correction of this big up move here. So I would typically count the number of bars making up this correction here. And for instance, this is 50 bars on the 5 minute chart. I used to require, well, I still do, I require a minimum of about 30 bars on the 5 minute chart. That would be about the smallest correction that I would allow myself to take. So this would be, it would be allowed because it's 50 bars. So I would typically not allow anything smaller than about 30 bars on a 5 minute chart. But today, however, I'm going to allow, maybe not even 10 bars on a 5 minute chart, maybe 15 bars on a 1 minute chart. So these are some of the things that I've been wanting to test, and having done so the past couple of days, it's looking pretty good. So that's what we're going to do today. All right, so let's set this up here. First thing that I want to do is disconnect from the data feed, obviously. And then we'll scroll back to May 1st and start marking up the charts here. Any questions about anything before we get going here? What I have, and we'll refer back to this periodically here, but this is just a basic kind of minimum set of rules that I'm going to be using for this little back test here. So with this toolbar, there's just so many different functions on this thing, but one of the things that we have, and it's actually just been corrected. I identified a bug in it today that has been fixed. So you guys in the trading room and everybody that owns it will have this new one here pretty soon. All right, so this little scroll thing here allows me to synchronize the charts. Ninja has a feature, global crosshair, but it's kind of a mess. So we created our own little chart syncing tool, and then we can also grab, for instance, I can grab this bar and center all 4 of my charts right there on that bar. So this makes doing the manual back testing a lot easier. And what we're going to do is we're going to scroll back all the way to May 1st. Let me go and delete everything. John's asking me a question here. Clarify how this differs from Bloodhound and Blackbird. Yeah, so this is for retaining that level of discretion. So that's what I was trying to get across. With Bloodhound, if you're going to run a complete backtest, fully automated backtest, you have to have every single one of your rules for entry and exit completely 100% defined. Obviously, that's very difficult if you're using something like market geometry, Elliott wave, maybe fib and fib confluence zones that you're creating manually. So if you have any type of discretionary method, yeah, thanks for asking that, John, because I didn't really clear that up properly. So in Bloodhound and Blackbird, you have to have every single rule for your entries and exits 100% defined to be able to run a fully automated backtest. Okay, you don't have to use Bloodhound and Blackbird fully automated. You could program out certain sets of rules, turn it on and off whenever you want. You can still retain that level of discretion using Bloodhound and Blackbird, but if you want to run a complete backtest and you want to prove out a certain set of rules, whether it has the potential of making money or not, you would have to have all of those rules completely programmed. Okay, with this tool, you don't have to know anything at all about programming. You don't have to have every single rule completely defined. And you can simply, and I'll show you when I start doing this, you can simply click on it, click on the bar that you want to enter, where you would want to exit. There's a lot of different ways that you can automate parts of your stops and targets if you want to, or you can have dynamic control. So you could use static, number of ticks, or risk to reward for your stop placement and your target placement, or you could use dynamic. And that's what I'll be using today, is the dynamic feature. So with this tool, it allows you to do the type of backtesting that I had to do when I was building out these methods. When I was putting all these methods together, I was having to do completely manual backtesting because I'm using, number one, market geometry. Number two, which is trend channels, median lines. You're drawing on the chart. You're looking for the slope of the market. You're looking for the strong areas of support and resistance based on previous areas of support and resistance. That's what market geometry is all about. And then number two, Elliott wave, looking at market structure, counting, threes and fives, trying to identify what is the major trend that we're in, what do the typical corrections look like. You can have sets of rules around those types of discretionary methods, but if any of you know anything at all about programming, well, you don't even really have to know anything at all about it. If you tried to program out the Elliott wave theory, it would be at least a 5 to 10 year long project, right? Because it is fairly subjective. There are certain sets of rules, but then there's also what they call guidelines, which are not fixed rules. They're guidelines. They're there to give you some idea as to the probability of one thing happening over another. So for instance, the guideline of alternation, wave 4 tends to be, like if wave 2 is a sideways move, then wave 4 tends to be a sharp correction. That's a guideline. So there's all these different discretionary methods that really can't be fully automated and completely programmed out. But you still want to be able to do some type of backtesting to prove that what you've put together has the potential of making money. And the fastest way that I know how to do that is using this tool, okay? Because what I did, I had to mark up, I think it took me about 12 hours to get through 5 days of marking up charts and figuring out, where I would have entered, trying not to have that hindsight bias. And that's another major problem with doing backtesting is, you tend to kind of want to look forward and talk yourself out of why I wouldn't have taken this trade because it's a loser. But that's one of the major problems with this type of backtesting. So that's some of the things that we'll get into here in a minute. Some of the pitfalls of doing it this way. But like I said, if you're doing discretionary trading, which most of you are, you still have to be able to test it. And you still have to be able to prove out that what you're using is useful. You can do it the long, hard, old-fashioned way like I did, or you can use something like this tool here. So, for instance, when I was working out, putting together all of these methods, I had already been using Bloodhound for a while and building automated systems for people, or at least building out their rules and then helping them put it together and test and do all that stuff. But when I was putting all this together, combining the relative volume, the volume analysis, market geometry, volume profile to some extent, and then the momentum divergence and all of that across multiple time frames, when I was putting all that together, I could program out certain sets of conditions in Bloodhound, and that would help to facilitate doing that manual backtesting. And we're going to get into that once we get the tools updated. That's one of the things that we'll be doing. We'll be using Bloodhound in tandem with this tool. So I'll talk about that near the end when I get into the nitty-gritty of how this thing works. But when I was putting all these methods together, before I started this track record started March 1st of 2015, and I ran it to April 1st. And it's so exceptional, it's ridiculous. And anytime I show simulated results like this, I have to, by law, show this disclaimer. So these are simulated results. It's not a back test, it's actual, forward testing using fake money, but it is simulated, okay? So before I started running this track record, I had to do all of this manual back testing. And I didn't end up getting the tool that I'm going to show you today until I had already begun doing my, running my simulated performance here. Okay, so this is what I had done over the past, well, it was a little over a year. Okay, and then now since then, my live results are not anywhere near as good as this. I mean, that's one of the things with trading in sim. You have, you tend to do about 20 to 30% worse in a live situation than you do in a simulated situation, but you don't want to start trading something live until you've proven it in sim, right? And you don't even want to bother wasting the time to start a simulated track record unless you've already done the manual backtesting necessary to at least prove out that what you're working with has some potential, right? So that's what I want to show you guys today, because what I've been thinking about, we've been running this trading room now for not quite a year and a half. It's been about a year and 5 months, and I've been focusing on, like I said, the larger setups, the bigger swings, and I've been watching a lot of really easy trades that set up that are not very large corrections and that you may not necessarily be able to get very much out of, but relative to the size of the stop and the move that occurs out of it, they still produce, very reasonable reward to risk trades. So I've been wanting to put something together to where I could begin to test some of these smaller setups, and that's when I started getting interested in this backtesting tool again. And then having talked with Adrian and put something together to be able to give you guys a discount with it. We were talking today, and there's a number of things that he's going to add to this that will make it even better. And he said that that development should be done by the time I do that webinar on the 22nd. Okay, so as nice as it is now, it's going to be even better, and I'll show you that. So let's go on back here. Did that sum it up pretty good? So John is saying, so this is a more formal and precise way to backtest. Well, it's a faster way of backtesting. So I mean, you could run market replay. You could just go back and mark up the charts and then log them in Excel, or you could use this tool, click on the chart, click where you want to exit, click where you want to take target 1, take target 2, and then have it all spit out into a beautiful statistical spreadsheet, and then also export that into Excel. So this is just a much faster, more efficient way of doing this type of manual backtesting. That's what it's all about. And I can tell you without doubt that just doing this exercise, if you guys would just using this tool and marking up charts, even if you stumble and you have the benefit of hindsight, it doesn't really matter. Just doing this exercise day after day, I would say at least 3-4 hours a week, preferably at least an hour a day. But just doing this exercise is going to make you better and better and better at pattern recognition. And that's really what trading is all about, right? I know that when I was in school, in college, my finance and economics professors, they all wanted to claim that the markets are random, right? Wasn't that all the big academic hype back in the 70s and 80s? Markets are purely random. That was professors and fund managers' way of justifying not having very nice returns. If the markets were random, then why would you ever think that putting together a set of rules for a trading system could possibly make money? If you're making money discretionarily trading, that means that you're very good at what? At pattern recognition. If there aren't recurring patterns in the market, if they're purely random, like the academics of the 70s and 80s would say, then you may as well hang it up because it's impossible to make money. But in fact, they're not random, they're what's called chaotic. You can research a guy named, I think his name is Francois Mendelbrot, talking about the fractal nature of markets and so many other chaotic systems in the world that people assume are random, but each has different sets of recurring patterns. And that's what price action has. And through the use of volume, momentum divergence, and then market geometry, which I think you'll see by the end of it, by the end of today, the market most definitely does have recurring patterns that you can take advantage of and make money off of. And well, that's what I've been doing. And it's working. So if the markets were random, I would not be able to do that. But doing this exercise, going through all this, marking up the charts, logging your trades, you'll get better and better and better at pattern recognition. And that's really what it's all about. So where are we at? 5-1. We're starting at 5:30. Yeah. Okay. So I do kind of have the benefit of hindsight here, but you'll see that we're following the rules that I've laid out in this little write-up here. And it's not exactly very, heavy with rules. It's just some basic stuff here. So let's get right into it. So all I'm requiring is one area sloping in favor of the trade. So wouldn't you agree with me that the market has been in a downtrend up until this point? So what I'm going to do is I'm going to F5, reload the charts. Reload the Ninja script. And get everything lined up here. And then try not to scroll too far past the current bar. So what I'm going to do, and I'll show you how to set this thing up now. I'm going to use my first target at 3.5 times my risk. So if I'm risking 10 ticks on the trade, I'm going to use 2 contracts, 2 targets. If I'm risking 10 ticks, then the first target will get me out at 35 ticks. And that'll be my automatic first target, just to lock in some profit. This is one of the things I've been wanting to test anyway, is getting out at a fixed reward to risk for the first target, just to, you know, a lot of times I'll be in a nice little trade and I'll be up 35, 45, 50 ticks, but then it stops on a dime. It doesn't do what I end up thinking it's going to do. It ends up coming back and making one more high or low, and then going and doing what I think it's going to do. And I end up giving back most of that profit that I had. So one of the things I've been wanting to test is, well, what if I would have gone back and actually exited with at least some profit worth the risk on the trade? And I'd say 3.5 to 1 is worth the risk on the trade. So just looking at this, what do we have here? Well, it's a number of different areas I could draw in on this chart, but it looks to me like we have a couple of pretty obvious ones here. Yeah, so we've been coming down, we've reversed back up into a major area and rolled down from it. All right, so the bias is to the downside. I'm not going to worry about getting really technical with all of this stuff. I'm just going to kind of keep the rules incredibly simple and go like that. I'm not even going to worry about looking that far back. So let's just focus on what's right in front of us here. All right, so it's 5 o'clock. I'm going to start trading at 5:30 to 11. All right. And it looks like, yeah, we've already had a really nice reversal from this high here. So I'm just going to start from there. So that's in the overnight, huge churn bar. A churn bar, let me just explain this for a couple of seconds here. This volume is the most important way of looking at price action. The price action is really second order. Most people would say that all of your oscillators, moving averages, stuff like that, that's all second order indicators. I would say that price action itself is second order. First order is what creates the price action, and that is the volume that changes hands, right? But looking at volume with the seasonality from day to day, the seasonality from overnight to the day session, the variance between the sessions, the variance between morning to lunch to the afternoon, it becomes incredibly difficult to read volume properly. So the relative volume enables us to look at the average volume per the time period that we're looking at, per the actual, for instance, this 5-minute bar. We would be comparing this 5-minute bar, its volume, to the volume of that same 5-minute bar per this time of day over the past, say, 10 or 15 or 20 days. Okay, so for instance, right here, previous bar was an extreme density, meaning that it's very high volume per range. It's extreme density and an extreme climax. So it's a very wide-ranging, high volume per range bar. Meaning that, yes, the market is going up, we have a buying climax, but the volume is so high that we've obviously run into resistance. And that shows up even better on the next bar. The next bar is what's called an extreme churn bar, meaning that it's incredibly high volume per range. Okay, and that's showing us a narrow ranging bar with very high volume. Obvious resistance is coming in there. Okay, so supply and demand is a function of the previous areas of supply and demand. It's not the exact areas themselves. A lot of people will trade, you know, well, this high is where supply came in, so that means that supply is going to come in right there in the future. That's not the way supply and demand works. The future areas of supply and demand are a function of the previous areas. And it's the market geometry that helps us define that. So that's what this is all about, looking at the market geometry in tandem with the relative volume and then the price action momentum divergence. That's why combining these three methods has been so incredibly powerful for us. All right, so right here, let's see, is it 5:30 yet? Not yet. I gotta keep scrolling. Okay, well, I would have missed that one because it's not quite 5:30. Okay, here we go. So it's 7 o'clock. We're right back into the same area. I would have loved to have taken that one. Look at that. It's a buying climax followed by a churn bar. That's the typical 2-bar pattern that we look for. But here, I've still got an area. It's downsloping. Look at that. I've got the median line intersecting it perfectly there. We're back into the downsloping area on the tick chart. Now I've got the 1-minute chart here, and I've got the 300 tick chart right here. Okay, what did I require? It's going to take us a little bit of time to get through some of these examples, but by the time we hit 4:30, I'll go ahead and show you how you can access this tool. But I'm going to keep on going, so for whoever wants to stick around and follow me through this, you're welcome to stick around. But I know that some of you are pressed for time, so once it hits 4:30, about another half an hour, I'll stop and then show you how you can take advantage of the one-time special discount we're going to do on this. So what I'm requiring, right, is a churn bar on any of the time frames to confirm the area that we're trying to trade from. I want one area sloping in favor of the trade, which you saw I had on both the 5-minute and the 1500 tick chart. And then now here, I've got the 2-bar pattern, that one of the main things that we look for, the buying climax followed by a churn bar here. I'll just connect the most recent swings to show you. They're lining up right there. And then I could draw the same. Use the highest close on the 1-minute. Hang on one second. There's the churn bar. And then here we've got very high volume per second coming in here. I could draw in the rest of the stuff, but you get the idea. We've got all the areas that we need. So that price, let's say that we didn't quite get in up near the high, but we got in at the close. So that's 49.20. I want to have an area to protect my trade. I want to have my stop behind that area. So I want to have my stop at about, let's say we get in at, let's just say we get in at 20. I'll put my stop at about 25. So let's go back to the 5-minute. Blow this up. I'm going to go ahead and start a new backtest. So you can set this thing up however you want. I'm going to set it up to save this backtest into my CL folder that I've created here for testing the crude oil. Yes. And let's say we name this CL, whoops, hotkeys for chart backtest. And then I'm going to start a new backtest. Yes. Do I want to duplicate the trades? No. So we're going to start over. All right, so now what I can do, since I want to use the dynamic backtesting rather than the static, because I'm going to set my entries from the area, but then my exits, the first exit, like I said, is going to be based on the risk to reward ratio of the stop loss. So if I'm putting 5 ticks at risk, I'll get out at 3 times 5 is 15, 17 and a half. So let's say 17 ticks. I'll get out for the first target. And then my second target will be based on basically the most recent obvious set of market geometry, which I've got defined somewhere here. Second target at the next obvious area or a break of the most recent major high or low. I have the feeling that probably shouldn't be broadcasting this to the world, but anyway. So what I can do here, I'm going to move my stop to break even after we hit the first target. All I have to do is click on Tool, choose Entry Location, Price and Bar. I'm going to get in at 49.20, put my stop at 25. See, it's taken the first one off right here, right? And then the downsloping area that I had on the larger tick chart was below 49. But what I'm going to do is I'm just going to get out once it gets below these previous lows. I'll get out if we can just break down there. So see, that trade was logged. So now I'm going to scroll forward and see if we didn't get filled there. Yes, we did. So target 1 came off right here. Target 2 came off right there. And you can see my entry price and where my stop loss was. 5 tick target, or sorry, 5 tick stop looks a lot bigger than it is right here, huh? So see, when you're trading, really precise areas that are lining up with very small corrections, you can get away with these small targets. A lot of times what I'm trying to do, I'm trying to get in what looks like a completely counter trend trade on the 5-minute, sometimes even the 20-minute, but then what would be with trend on the hourly or the 240-minute chart. So a lot of times I'm getting in a little bit early, and if I would have had just a little bit bigger stop, the trade would have gone on to work out. But in these cases where you're looking at these little tiny corrections and you can get in right on the area when you get the volume signal, you can get away with these much smaller stops. So let's scroll forward a little bit. Okay, so for instance, if I wanted to, take this one step further, I have a larger area that I could have traded down to down here. So this would be actually where I would be expecting it to make it to. But for the sake of, running a simple back test, not trying to, knock it out of the park every single trade, just trying to bank some profit, make enough for the risk to be worth it, and just see what the results are going to be. But this is where I would be expecting to make it down to, and there you go. And when you started hitting the area, look at where the volume started coming in. But then it just kept coming down anyway. And there you've got a huge amount of demand coming in on that bar right there. And that's what knocks it sideways to up. I could line this up here and take a short there, because this is what I'm allowing in this back test. What I've found over the years, obviously the more trading that you do, typically the worse your performance is. That may not necessarily be true for everybody, but most of the people that I've come in contact with and talked to and had conversations with about trading, that seems to be one of the major problems, is over trading. So I tend to want to limit myself to no more than 2 trades or 3 trades per market per day. And that's usually much more than I would even do. Most of the time I'm not taking more than 3 trades per day, sometimes no more than about 5 per week. So what I'm going to do here is limit to about 2 trades per day until we get to the end of where we're at today. So it's really only going to be about 7 days of trading. So I just want to kind of give you an idea of how this works and show you how interesting what I'm doing here is, because it's actually looking pretty incredible. So this is even a very obvious one right here, isn't it? That is a very obvious swing high, isn't it? Yeah. Buying climax followed by a churn bar on the 5-minute. I'm sure it lines up with something on the tick chart. So anyway, let's keep going. We'll get to 5:30 the next day. $4.30. And you see, as I'm doing this, it's scrolling all of the charts with it using this chart sync tool that I have. Okay, we're about 5:30 right now, so this is where we can start. Okay, let's see if it might be something setting up right there. I'll delete that and redraw it. So it looks like it's breaking out here, but what's happening is it's breaking out of the downsloping channel. But you see here, we missed the bottom of that downsloping channel, so it's stepping up in that channel. So we have a new slope developing, and that's coming right in. That's a trade right there. That's really all I'm requiring is 2 areas, and in this case, it's a symmetrical move. We have the median line intersecting its channel line. So that's it. That's all I'm requiring right there. And look at that. We've got a huge, big, beautiful churn bar. Buying climax followed by a churn bar. This is relative volume, though. This is not true volume. It's relative volume. And let's see. I just want to see if we have something else on the minute chart just to throw in. Yeah, it's lining up the same on the minute chart as it is on the tick chart, which is kind of rare. So yeah, we've got all that we need. It looks like it's even an ABC up into that high, actually, or a double 3 maybe. Yeah, it's ABC, X, ABC. All right, so really I don't even have to look at the 2-minute or the other small tick chart. We have everything we need right here. So I'm just simply going to figure out where I want to exit. So if I were to get into this, what do you think that I can expect to do? I'd like to be out of the trade by 11, but in this case, we've been in a huge downtrend for a while. And, oh man, I didn't mean to do that. Okay. Well, you see what happens. This is why using market replay is a great way to do this, but it's faster without market replay, obviously. So let's say that we would get in right here and then expect to make it to the bottom of its channel. I mean, we've already come through this channel here, and this is the most recent and obvious of areas. So let's just, rather than using hindsight like we have, let's just say we want to trade back below the previous swing low. So let me line up on the 1 minute and the 300 tick just to see if we don't have any areas a little bit higher. Yeah, obviously quite a bit higher. But here, I'm not going to worry about all that. All right, so let's mark this up. So I'm going to click on Tool. I'm going to get in right here. And then I'm going to have my stop far enough outside of this channel. See, this is a much wider channel, so I need to have a, fairly large stop. Not too large, but let's say about 13, 14 ticks. So we'll put it about 32. It might even stop me out here. And then this would be target 1 at 3.5. I'm going to put my target 2 a little higher, actually, just below the previous low. And then we'll scroll forward and see. Didn't quite get stopped out. And then those get logged into the statistics spreadsheet. Okay, so let's keep going and try to get as many of these done as we can. And then the massive sell-off into the close. I think this was, no, it wasn't this one, it was the next one. Supposedly a very large hedge fund with a huge long position in crude completely liquidated their position. And it was either this one or the next big sell-off where that happened. All right, so now we're coming up on the 3rd. I think the 3rd was a Wednesday. So on a Wednesday, we're not going to trade past 9, and we're not going to hold any entry after 9:20. Okay, so if I take a trade, it would have to happen before 9 on a Wednesday, as we have the, the huge, crazy report every Wednesday. All right, so that's 4:15. That's about 5:30 now. There's 5:30, okay. So just setting this up, what are the most obvious swings we have in front of us? Well, there's a high. There's a high. Got a high there. This one's probably not going to do much good, but I will draw a parallel back to the low here. And we're obviously in a strong downtrend. I'll trade maybe not below the low, but to the bottom of that channel if we get a short. Okay, there's a nice pullback right there. So our area is just a few ticks higher on the 5-minute. I'll go ahead and draw a full trend channel. I'm going to draw a bigger channel from further back. That's a pretty amazing channel, isn't it? We traded right through that, right to the bottom of it, through that huge sell-off. It's pretty impressive, actually. I'm going to leave that one on. Okay, I'm just going to update it forward. You see the big low that we hit right here, right where the median line's intersecting that channel, and then we came right back down to the channel again there. So I'm just going to update this one forward a little bit. So see, these are the things we can't do automated, right? We will be able to do some of this stuff inside of Bloodhound and Blackbird. Well, we'll be able to do a lot of it, but we won't be able to apply the channels automatically. We still have to do that manually. And then I'll do one opposite just from low to low, just to see if we have, no, we don't have anything, but we do have that midline there. You see that? So that midline is coming in at this high as well. Now I'm just going to leave it at that. Okay, and here is the pullback that we're looking for. That's really all we need right there. We've got the downtrend line, we've got the downsloping upper median line. Now let's see what we have over here. Okay, we've got a downsloping upper median line right here as well. And then it looks like we've got a tiny little ABC up right there. You see that? And what do we have at the end of that on the 1 minute? You got a big buying climax, 500% normal volume, followed by a churn bar, then it drifts up on really low volume. And then once it hits that line, that obvious area, I don't know why people don't trade with, I mean, it's the most useful thing that there is market geometry. I really don't need anything else. I have all the confirmation I need. I have all the areas that I need, and there's my volume confirmation right there. You see the churn bar there? Very high volume per range. That's where the rest of the supply is coming into the market right there. Pretty incredible. So where do I want to get into it? And where do I want to get out? Well, depending on the size of my stop, it'll take, again, the first target at 3.5, reward to risk. And then I've got enough room down to the bottom of the channel here. But the area that I have in front of that, I would say, is right here. So I'm not going to get crazy. That's 08. That's about 65 ticks, 60 ticks, something. Yeah, let's not try to get all the way down. Let's just get in near the area, about a 5-tick stop. It's going to take one off here, and then I want to just get below this low. So we'll take the other one off right there. Trade is logged. I can scroll forward and see if we got filled or not. Okay, there. Whew. It's a pretty big retracement there. All right, actually at that retracement, we probably had another area. Yeah, we did. I'm not going to worry about all that though. So we've got this one logged, and look at, you see this high right here on the 5-minute? That is this high as well. So you had a little, kind of a small buying climax into that, but on the 1 minute, you had a strong reversal bar out of that. It's also the VWAP, the volume weighted average price. So you had the buying climax here, which closed off of the high. So you had obvious supply coming in there, drifted up a little bit higher on very low volume, and then you have the high volume reversal bar right there. So we could mark that up. I'm sure there's at least one area there. You saw the one from the 5-minute. Let's see. Yep, right where the median line intersects the channel line, right at the VWAP on bearish divergence. And then you had bearish divergence here at the high as well. So that could have been another trade as well, but let's scroll forward and let's do one more, and then I'll show the statistics, and then we'll go over how you guys can get access to this, and then I'll keep scrolling forward, and we'll do just a few more. Samir, are those saved tests replayable by others? Yeah, you can send the backtest to other people. I'm pretty sure, yeah. And then they can bring it into their folder and then load the backtest and then see the orders on their charts. You know, it's a pretty good way to learn from each other too. If like you're working with somebody else that's a trader, you guys can you know, do your own backtest and share and, you know, gather as many different trades and backtests as you can and then put it all together. Yeah, I'm just going to let you guys take care of the questions. It looks like they're flying in. So, all right. Let's scroll forward to, well, that's a trade right there. It's got to be. It's at least an area, so let's log it regardless of what happens. It's a trend line from way back. Sorry, I think I was talking to myself there for a second. So it's a big trend line we've pulled back into. Let's look, yeah, I'd say it looks like that's a nice little ABC correction into that high. It may continue on higher, but for the sake of this test, it's into an area. We've got the churn bar. We have everything we need just on this. No, we need one more area, actually. I need one more area. That one doesn't count, no. This one might. Not quite. Let's see on the 1 minute. We got a nice volume signal on the 1 minute anyway. I do have the warning line of the previous channel there, but that's not exactly looking too pretty. Yeah, that'll work. That's the low before the big high. So that's the swing just before, the swing low just before the high. So that's the last place where demand came in before the huge amount of supply started coming in and working this back down. And then that's giving us the slope of this channel connected to the low here where demand came in before the final area of supply came in here. Demand came in again here, and now it looks like supply is coming in again right here. So that's supply and demand. That's the way it works anyway. So I'm just going to try and trade somewhere down near the bottom of this channel, basically just below the low. So let's get in right there, put a stop right there. First one will come off here. I'll just take the second one off there. Okay, so that trade was logged, and I think I got stopped out, didn't I? Oh, that's sorry. I didn't mean to take that one. I wasn't supposed to take that because that's after 9 on Wednesday. So I think I just broke my rule. Yeah, I did. Okay, so I would have to take that one out, and I can do that. I can reset, just kill that last trade, or I could reset the whole thing. But rather than doing that, let's just run the statistics, show you guys how that works, and then I'll show you how you guys can get this. See, I almost got stopped out, pretty close. But that's, you know, the report came out right then, and it shot it straight up and straight down. So I shouldn't have been in that anyway. It's obviously, that's the time where, you know, you get the 10 tick slippage on your losing trade, trying to trade that report. So, all right, let's do this. Show statistics. We don't have very many, obviously, and I don't have any losers. I should have tried to get at least a couple of losers in there for you. We'll do that when we scroll forward and keep logging some trades. But here we have 4 total trades. You know how Ninja logs your basically it logs each contract as a separate trade, you know, and then it doesn't do any of these numbers correctly after that because, you know, it's treating each contract as its own individual trade when that's not how you're trading. So this does it correctly. And, you know, obviously it has all the important metrics. You know, the main ones for me are the R multiple. So Ninja doesn't have this Kalmar ratio and the R multiple. Chris Bunn, one of the guys in our trading room, is a, I don't know what I guess he's a risk analyst. He works with traders to help to teach them the ins and outs of managing risk and whatnot. And this R multiple being used here is the one from Van Tharp. So Van Tharp is, he's got to be one of the main authorities on risk to reward analysis. And, you know, he's got a massive couple of books on it that are really expensive. So anyhow, this is the R multiple from Van Tharp. So that's in here. Yeah, anyway, let's go over some of the layout here. So you've got all of your trades numbered out here. Tells you the entry time, the date, obviously the price, all of that. Where both your targets are, where your stop was, the R multiple here. I think the realized R, yeah, see, this is what's so important here. Your realized R, which is your, you know, how much reward you got versus how much you risked on the trade. And then your maximum adverse excursion and your maximum favorable excursion, which then give you your entry and exit efficiency. And that's why trading the way that we trade is so, it's just the way to do it, because you're getting out rather than using a trailing stop. Typically, when working with Bloodhound and Blackbird and all that, and doing all the tests and testing all the various different trailing stops and different exit strategies and whatnot, trailing stops tend to give some of the worst metrics, especially for exit efficiency, because, you know, by definition, it's a trailing stop. So your maximum favorable excursion, which is how far the trade moved in your favor, the maximum distance the trade moved in your favor, you're never getting out there with a trailing stop. If it moved 50 ticks in your favor, and then you're getting out with a trailing stop, depending on, you know, how close the trailing stop is, by definition, you're giving back a good portion of that trade. Now, I know a lot of people use those. A lot of people supposedly even trade successfully with that. I mean, I know they do, because there's a lot of trend following CTAs, commodities trading advisors, that use trend following systems, and they all have different types of trailing stops and whatnot. But when you're getting out directly at areas where you can expect there to be, you know, high supply or high demand come in at those areas, and then you're getting out very close to the maximum favorable excursion, that does a world of good for your metrics and your R and your your exit efficiency. And obviously, when you can get in right at the areas to begin with for the entry with a fairly small stop, then your maximum adverse excursion is very low. And all of that makes your metrics pretty nice. But, you know, we've got, what, 4 trades here. So we need to keep going and keep going and keep going until we've run through at least 100 trades. So this is something that I would really want to start back, let's say from January, using these 4 charts, and just go day by day by day, bar by bar. And the way that I did this before was by hand. I mean, I would mark it up on the chart. I would find the price. I would punch that into Excel. Where would I exit? Why? You know, mark it up, screenshot it, put it into Excel. So this way, you just click on it, click where your stop would be, click where your target would be, and you can even do the risk to reward stuff automatically. So it's really nice. And then of course it spits it out into this statistical sheet here for you, which is something that I had to do with my own spreadsheets. So of course you can export it to Excel, and you can analyze your exit, your first target and your second target independently, which is also very nice. And Adrian's going to be adding several different features with this. And another thing that he's adding, which is going to be really awesome for us, is the ability to, for instance, when let me just mark up a simple area here. Let's say I, excuse me, I click on this, I get in right here, and then I put my stop here. Rather than having to put that second target in right now, we'll be able to click a pause button and then start marking up the chart, scroll forward bar by bar, and then once we see that we've hit the area that we're at, we've had the volume confirm or whatever, then we can decide to put that second target in, or even if the market moves too far against us, then go ahead and take that second target as kind of a trailing stop. So that's the next major feature that he's going to be adding, which he says should be ready by the time we have our webinar on June 22nd. So let me go ahead and show you guys how to get this. Adrian is asking, does the software metrics look at campaigns which might consist of multiple positions, so multiple exits or entries are combined into one trade? Yes. Yeah, you can actually scale out of your stop. So you could do a layered stop. You could do, depending on how many contracts you have here. This one lets you have, I think, up to 3 targets, which I think is enough for any trade anyway. But yeah, you can have tiered stops, obviously tiered targets. I don't know that it would treat scaling in as part of the same trade. I don't think there's like a scale in feature on this yet, if that's what you're asking. Ron is asking, does the testing allow more than 2 target locations or handles additional contracts? Yes. Yeah, multiple contracts, I think up to 3 targets, which I think is really all you need. Jim is asking, what does he charge for the software updates? So the software updates are free. So let's go over that. So here is the page. I'm going to put this in the chat now for everyone. It's $197 for 1 license. All upgrades even are free. So he's planning on moving to a standalone Windows program that would work on potentially any platform that's going to be a lot, I guess, just a lot nicer, a lot more robust and easier to work with maybe. So he's planning on a really huge upgrade, but that will probably be a little while. The next major upgrade will be the couple of features that I was talking about, to where you could pause and then mark up your charts, scroll forward, and decide on that second or third target once you've had enough bars come in and you can see the confirmation or whatnot. There's a lot of information here. This is looking a little weird, but you can click on these tabs here and find out more information on this. And then this video will kind of walk you through the majority of the features. I think this might be from an older version, but most of it's the same. There's just some new features now. Yeah, I think this is the older one here. So 1 license for 1 computer is $197, 2 is $297, 3 is $347, and until until Sunday. It's supposed to say here that 10% off until Sunday night. But what you can do is use a coupon code 10 capital O lowercase ff. 10OFF, and that will get you 10% off either one of these three. So if you want just one license, I think it comes to 177 something. And then 10% off of this would be minus 30, so 267. Okay. Let me see if there are any questions here. And then that 10% off will be until Sunday, and that'll be the only discount that we'll ever do on this. It's a pretty awesome piece of programming for 200 bucks. Let's see. You say you look for 2 areas to line up, but I'm wondering just how easy it is to find 2 areas when it's so easy to draw endless channels everywhere. Easy to draw endless channels everywhere. No, I'm using the most recent swings. It's easy to cherry pick, but if one can locate 2 areas syncing easily, then it creates a false impression. Sounds like you don't necessarily use market geometry. I mean, if you're drawing lines all over the place, then yeah, I guess you could get some to line up, but here, to get areas to line up right here, you know, using these swings that are available in front of you, what would you do to finagle it to get all that to line up? I mean, I guess you could do something crazy like this and, you know, draw weird lines everywhere, but we're talking about using the major areas where supply came in, the major areas where demand came in. And we're looking for the smaller corrections, the intraday smaller corrections that I typically don't take. So, you know, here these aren't lining up here, you know, but you've got the big trend line coming down where they're all rejecting off of. So, yeah, you know, I don't know if you're going to draw a whole bunch of lines all over the chart to where it's covered in lines, then yeah, I guess you could say that you could form fit it, but one wishes to backtest, you need to be able to apply an idea in a consistent way. Right, exactly. I don't know what is that a question? What toolbar function am I using? This is the chart sync button. It's called, where is it? I think it's just called chart sync. Yeah, chart sync. In the old toolbar, it's called turn on chart sync. Turn on chart sync. And this one, turn on chart sync. Let's see. Can I delete the row in stats? I think you can, yeah. Right, so if I want to delete that last trade, was it this one at 9:20? Where was it? It was on the 3rd, right? Yeah, it was this one. I think I can delete that right here, yep. And I can remove that from my stats. You see? There's 2.14 on the website, Ron, in the members area. You can download 2.14. This new one will be released here soon. We finally got the volume profile done. Well, it's mostly done. It's not completely done, but it's a volume profile that you can put on any chart, any workspace, and it doesn't bog Ninja down. All the other volume profiles, you have to load a one-tick data series onto the chart, and this one doesn't do that. This is the most efficient, fastest, and cleanest profile available for Ninja, and it's not an indicator. It's basically a custom drawing object that works as a profile. So it doesn't eat up all of your resources and slow Ninja down like all the other profiles do. No, there never was a 2.9, Ron. There's never been a 2.9. Two 2.14 is the latest one on the website. It works fine with everything. You mean, how does the DLL install with Ninja? I haven't had any problems with it. I don't see that a reason why it would interfere with anything. I've been using it for a while, and I haven't had any issues with it whatsoever. I did find an issue with this chart sync button today, though, and that's been corrected. So this new toolbar is going to be pretty incredible. Well, it is pretty incredible. No, Tony, not yet, but it will be soon. I mean, I'm going to have everything will be done for sure by the webinar on the 22nd, June 22nd, but I hope to get this out to you guys before that webinar for sure. Okay, Mr. Deck, thank you. All right, well, I showed you guys how to get access to it. It's right here. I'll put it in the chat again. And, you know, 10%, it's not that much, but it's a pretty amazing tool. And this is the only time we're going to do any kind of a discount on it. It's, you know, it's not our product, so this is the only time we'll be able to do that. And that discount is good until Sunday night. Would you put that on the website for me, Clint, please? That countdown timer until Sunday night. So I'm going to keep on going forward here. Adrian, I think maybe by the time we get done here, sorry, I'm trying to read something. You'll see how it's not form-fitting marking up a chart. If you do too much of it, I guess it could be, but yeah, I see Floating Toolbar Pro 2.9. How in the world? We've never done a 2.9. There is no 2.9. Where's that list coming from? Huh. It's very odd, Ron. Can you show me a screenshot of what it looks like? I might need to get up with you, Ron, after we get done here. I'll log on to your computer and get you updated. Yeah, I'll get on his computer, Clint. I'll hook it up for him. Just send him the TeamViewer login, and I'll get on there. I don't know what a 2.9 is. Let's keep on going then. You guys have the link. So I'm going to keep logging some more trades. What is today? The 3rd. All right, let's go to the 4th. That's the kind of look we look for right there. You see the huge buying climax. which is the blue bar, but it's a high density bar. See the plot? You got two plots here. The plot on top is the relative volume. It's looking at the amount of volume that traded on this bar relative to the average volume per that time of day. And then the plot behind it is what's called relative density, which we're looking at the amount of volume per range relative relative to the average volume per range per that time period. So this bar is a very high volume, high density bar. So it's a buying high density extreme climax bar. And it's closing off of the high. So you had supply coming in right here. Buying it up, we hit a brick wall of supply and it pushes it down. This bar initiates the next up move on increased volume, very high density as well. So there's a lot of demand, but it's going through a lot of supply as well, which knocks it sideways for a couple of bars. And then the big buying climax, which is also very high density, closing off of its high. So we've already begun to hit supply right in here. And then it moves a little bit higher and hits even more supply, closing off of its high and reversing back down, having broken the high of the report. And then it rolls down. So that's the perfect kind of a look to what we're after. Here we've broken out of the top of it too, so that's a throw over of the area. And I think it was, in this case, it was trying to get back above that report high and run all of those stops. And then we're coming down, so let's get to the fourth. Let me refresh all these charts. Warren, this is the new relative volume that I'm testing. So we've redone everything. So we've been in heavy development mode, 2 full-time programmers, and then I'm working on the specs. So this is a prototype. But you guys will have this here soon, and it's much more accurate. It's much better. Instead of 2 indicators, relative volume and density, it's both of them in one, and you can elect to show the density or not. All right, so I'm just refreshing the charts. I'll keep going and marking up until today, basically. And then, you know, you guys are welcome to stay, or if you've got to go. Let me see. Demoed it before. Where's the members area? Having trouble finding all my previous TTP purchases. It says you're an anonymous viewer, so I don't know who's asking the question. But if you can email support@tradetheplan.com, Clint will take care of it for you. You should be able to access the members area from the login page. So when you go to the website, just click on the login here. And typically when you sign in, it will take you to the members area that you're signed up for. But if you have a couple of different members area, it will take you to one of them. And then you can come back to the login page. And these are all of the different members areas. All right, let's get to 5.4, 5:30. All right, that's after 5:30 now, and we're going down, so we don't have any chance of a trade setting up right here, right now. All right, so let's mark this up a little bit. We're obviously going down, 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 so we only want shorts. Well, we don't even need to mark it up until we start turning back up. All right. Okay. So that's the first potential low that we have. Let's see if it's going to hold. That might be a swing high. Let's see. It's a tiny one. I mean, that's only about a 20-minute retracement, but let's see. See, these are the kinds of things that I'm wanting to test. If it's worth me risking money to take these really tiny pullback trend trades from an area, only from an area. Never just, you know, out in space or from something ridiculous like a moving average or something, which has no bearing whatsoever on price. All right, so it looks like we have a nice area coming together up here, but nothing really from where it's at right now. We had a obvious one at the high here. Let's see what else. And we've got room down to the bottom of that channel here. We are at the midline. I wouldn't be surprised if it goes straight down from right here. But let's see. Looks like it might have found some support off of that. Maybe it'll come back. I don't really like this one though. Let's keep going forward a little bit. Okay, now it's come a little higher into that, almost to that downsloping median line, but we have at least hit this median line from low to low. And you've got a huge amount of volume come in right there. Huge amount of volume per tick. This is a very tiny retracement, obviously. But it's looking like it's tracing out a channel here. Pretty much. I mean, it's only about a tick from hitting the top of the channel. $38.2. Let's see. Yeah, see, we're pretty well through that one. And that's pretty much the median line that we're at. I'm not going to allow that. It might go straight down from here, but oh well. Okay. It's pretty high volume per second into that high. We're finally at the top of this channel now on the tick chart. I think that's likely the high. It's not coming all the way back to the channel on the minute chart, but it's looking like it's just the trend line from high to high lining up here. Pretty much, yeah. So you've come close to the big downtrend line. That's the main area that we would be trading, but it didn't quite hit it. It's only about a tick away from it, really. Yeah, it's exactly a tick. So that's very likely the high. But you know, didn't quite look perfect. So let's just see what happens. Yeah, it goes straight down from there. So there you go. I mean, that's essentially, for all intents and purposes, that's a hit of the downtrend line, really. I mean, it's 34. It's really less than a tick. So yeah, that's a hit of the trend line. And then here, you've got the upsloping trend line. So that's two areas coming together perfectly. Just half a tick away on the tick chart, and then the same area on the minute chart is a little bit further away. So that's the typical difference between the areas on the minute and the tick charts. Adrian is asking, how do I deal with a situation where I get price hitting two areas, but there are no volume indications, I don't take the trade. If there's no volume, I'm not gonna, that's what the volume is for, is to confirm the area. So if if the volume doesn't come in there, then I don't take it. And that keeps me out of a lot of losing trades. Or the other situation where volume comes in and price falls short of hitting the two areas. Yeah, if it falls short, I typically just don't take it. Anytime I've done that in the past where I'm trying to get in where the volume is coming in before it actually gets to the area, anytime I've attempted that in the past, most of the time I've been early, and then I end up taking a stop and then potentially a second attempt, and running the risk of getting stopped twice on the same attempt, on the same area, on the same trade. And that's never a good thing. It's never a good feeling either. So yeah, if the volume doesn't come in, then I don't take it. I mean, that's the only reason. Putting these three methods together is the only reason that I've been able to make money. I don't know any other way to do it. I know there are a lot of different other ways to do it, but I don't personally know what they are. I wish I did, but this is the way that I've figured out how to trade, and that works really well. So this is what I use. Whoops. All right, so now 7 a.m. Okay. So we've got a huge selling climax here. It's massive. Yeah, it's so massive that the 1500 tick chart is taking up about 12 bars here when it's only about 4 bars on the 5-minute. Typically, the 1500 tick is much slower than the 5-minute. But you've got so much volume coming in that the tick chart is just piling up a ton of bars. I don't know what happened here. Everything, it just shot forward. I think that's the bug in this chart sync. We're still trying to, I fixed a couple of bugs in this chart sync thing today, but I think we've got another issue there. All right, so we've got a retracement here. That happened so fast that pretty difficult to catch something like that, obviously, but you have this channel coming in here. I'm going to go ahead and I'll leave it because you do have the median line there, but I'll delete this other one. So you've got the median line coming through the channel right there, which is where it's come up to, one of the spots it's come up to. And then let's see here, we've already broken out of the bottom of this channel. This thing keeps getting all crazy on me. I think it's just a trend line right there. Yeah. Perfect hit of the trend line. So let's say that we didn't quite, well, let me just show you what else it is. So anytime we're trying to trade a correction, we want to see what a channel on the waves within that correction will look like. Sometimes if it's a big flat, it will go right through the upper median line, the upper channel line or whatever, and not trace out a channel, but still be a correction. And then it just runs into the next larger area. But typically if it's a zigzag or a double three or something that kind of traces out in sections of waves, it tends to trace out a channel. So in this case, we have such a massive up bar there that if anything, it probably lines up with an upper median line and a warning line or something. Let's see. Yeah, see there's the upper median line. where the 100% warning line intersects it. The 100%, so the width of the channel added to the top of the channel, that's the 100% warning line of the channel. And then the upsloping upper median line, they're both intersecting right there. That's where we would have liked to have gotten in, but you had about 4 or 5 seconds to figure out what you're going to do. And you missed that. You very likely missed that. So I would say look at the size, looking at the size of that churn bar on the 1 minute, that is very likely the lower high right there. So I'm going to get in on the 5 minute right here and simply look for a break of the low. You can look at a couple of different things. Rather than using that wick, I'll use this median line, this higher low here with a parallel, which is the same thing as a channel. So I'll get out of the second one about 68, something like that. So I'll get in where it's at right now and put a stop. Not too, it's got to be behind the area, but that's a pretty big stop. So let's just put it at about 11 ticks. And then I'll take the second one off a little bit lower, about 68. It says that trade was logged. Let's see. Okay, yeah. So that was it. And again, these, well, I guess I shouldn't teach too much. These big, when you're in a strong downtrend and you get a big, huge, wide-ranging bar back up, it's typically the end of a short covering rally. And you tend to get the V-top rejection out of that. And it's almost impossible to catch something like that unless you're pretty quick and you're hitting the market entry, market order button. But then if you get lucky, then you get the pullback, and as it pulls back, you run back into some of that resistance that you found at the previous swing high. And then that shows up very well, obviously, in the volume. There's a churn bar there. And then right there, you've got the 2-bar pattern, the typical big selling climax followed by a narrow ranging, high volume, high density churn bar. It's pretty nice looking. And then on the tick chart, it's moving so fast that you can now draw a channel on it. And we make it to the bottom of the channel and through the bottom of the channel. And then where it stopped probably keeps going down from here, but this is at least a temporary low. It stopped on a big churn bar, and then you get the leading climax bar back up, kicking off that attempt at moving back higher. All right, I guess I'm doing more teaching than I am trying to log trades. So let's see if we can't log a couple of more. What day is this? The 4th. Let's go to the 5th. Well, let's see what happens. We might have been able to set up a tiny little correction here, but I'm not going to worry about it. And then we go down, down, down. I'm sure there was one there. I think this is where we get the big sell-off. Yeah, supposedly this is where that hedge fund closed out all of their long position, which seems weird to me because oil trades from month to month. So I mean, at what point did they put that big long position on? That must have been a massive loser. Couldn't imagine. No, yeah, I can. Never mind. I can definitely imagine. All right, so that's a retracement high, but that's 1 in the morning. And then it just didn't come back very far at all. It just kept going straight up. All right, let's see, 5 o'clock. So we're obviously looking for longs then. I mean, look at the size of that retracement back up. That's no retracement. That's a new impulse to the upside. We've just taken out the previous swing high. And now it's getting knocked sideways a little bit. 515, 530. All right, so we're looking for the first kind of A wave down low. Okay, this is probably a swing high. You see this little buying climax? It's a major spike in volume, and it is connecting the highs. It just overthrows that a little bit. It's actually probably a symmetrical, not quite symmetrical, but it is the top of that little channel. So this is likely the high, and now we're coming down. So there's your first 2-bar pattern. That's a little selling climax followed by a churn bar. Do we have anything upsloping? No, we couldn't have anything upsloping, right? No, maybe a midline. Let's see. Yeah, that's further down here though. So we don't have anything there that's upsloping at all. Okay, now we're through the midline. You're at the first warning line and through the median line, so it may be putting in a low here, but you don't have anything that's upsloping. Maybe on the tick chart, let's see. I don't think so. I don't see how we could. You know, maybe if we were allowed to use a 240-minute or an hourly chart or something like that, we might have an upsloping lower median line there. But yeah, there's nothing we could have that's upsloping, and that's one of the requirements of the test that I'm doing. So if it goes up from here, then we'll just have to watch it happen. And there's no way that I'm looking for a short, so if it goes straight down, then, you know, forget about it. We probably could, well, let's just set it up anyway. I'm not going to worry about logging it, but it's so tiny. Well, this is a bigger tick chart. It's probably not so small on the 1 minute, but anyway, I'm going to click from low to low. So that was the first possibility of an upsloping area, was at this low, because we're connecting the only 2 previous lows that we have. So that's the only possible area that's upsloping. And it's probably not going to line up the same way on the minute charts because of the overnight session. You have, you know, different number of tick charts than you have minute charts, different number of bars on the tick charts than on the minute charts. So here, if I connect from the low to the low, you see how it doesn't come back to the median line here when it does over here on the tick chart. It's because of the difference in numbers of bars. But anyway, this is looking like a nice little box, a little perfect little channel in this very small retracement. So I may as well point it out. I'm not going to log it though. But you see it right there. What did I require? A high density climax on the 1 minute with high volume per second, or a churn bar on any chart. So this is a high density climax bar, and it's closing up off of the low. So there's obvious demand coming in there. That's what's so awesome about the volume. It shows you all of this without having to think about it. And we've come down to the median line there. Not quite to the channel, but it's only a tick off of it, 1 tick exactly. So, you know, for all intents and purposes, that's a perfect symmetrical channel. And look at the high there. That's a huge amount of churn. That's a huge churn bar. Buying climax followed by a narrow range churn bar that knocks it sideways into the correction. And then here you've got the high volume per second pushing it back up. You had high volume per second coming down into the low, and the last bar was actually very low volume per tick. So not a lot of, not a large number of contracts per tick, very low number of contracts per tick. And then buying it back up, you had that push back up occur very quickly on very high volume per second. And this is probably a perfect little channel here. Yep. So anyway, that's the kind of thing that we look for as far as a correction. And this could be on a 20-minute chart, a 5-minute chart, or a 1-minute chart, or an hourly 240, the same kind of a look. Doesn't always look like that exactly, but that's the kind of corrective pattern we look for. Adrian is asking, okay, see Andy, of the times I get stopped out, what proportion do I find is because my stop was too close compared to simply getting the market set up completely wrong? It's a good question. I'd say probably half. A lot of times my stop is too close because I'm going for a setup that's occurring on a 240-minute chart or an hourly chart. With the way that we trade, I mean, we're trying to fine tune that exact entry, that exact area where the market's likely to reverse. And I'm doing that, you know, trading an area from an hourly chart, but fine tuning that on a 5-minute, a 2-minute, and a tick chart, and waiting for that confluence of areas. And I at least wait for that, but sometimes right where I'm getting in is right where that throwover is starting. And then it just kind of pops outside the area a little bit and then goes. I can't tell you how many times I've caught the high of the day or the low of the day with my stop. Quite a bit, actually. But somehow I still seem to make money. So it does get frustrating, though, I tell you. All right, you've got 3 big churn bars in a row on the 5-minute right into that median line, but you don't really have much of a reason for a swing high there. So, and you're definitely not trying to short. This would be where you would be getting out at if you were long. I wouldn't use that low. If I were trading this, I would use the higher low because that's a huge sell-off. It's a throwover, and it's just a ridiculous move. So I would use the higher low. And that would be the exact spot that I would exit this long trade. So I would buy there, and then I would exit exactly on that churn bar before the high. You know, and it may keep on going, but that's the safe spot to get out. That's why market geometry is so nice to use, because it dictates, you know, where your targets need to be, how much you can expect on the trade. And just to show you what that high looks like on the smaller chart, triple divergence in the momentum. See how it, you know, it looks like a straight shot move on the 5-minute in the tick chart, but when you zoom in on those bars, you see the waves getting smaller. You start getting into a tight narrowing range, and at the highs you get this high volume. And then what do we have here? we've got volume divergence, and that is one of the main things that we look at. And this is triple divergence in the momentum, which was about a 3-year-long project to figure that thing out. But that's finally done, thank goodness. So anyway, it's looking like it's a likely swing high here, and then you see the top of the move. The last bar here is looking like an ABC up into that high. So this is very likely the high, and we would be looking for, what is today? The 5th. So we So we would be looking for basically a swing low to get long. Let me see. All right, let's see. I'm going to use the higher low here. And then connect the highs together. Yeah, that was likely your swing low there. The goal is to make money rather than pick turning points. Ron says he gets stopped out or missing them by 1 to 2 ticks. I'd say we all do that, don't we? Doesn't everybody get stopped out and miss some trades by a couple of ticks? The way that we're trading is probably very different from the way that you're trading, Adrian. What some people call confirmation, I call unnecessary risk being added to the trade. So maybe you wait for the market to move in favor of your trade and then you get in. The way that I trade, if I did that, then I'd have to have even larger stops. So the way that it works for me, doing that, getting in right at the area before the turn with a smaller stop, you know, even if I'm only right 45 to 52% of the time, I'm still making a tremendous amount more on my winning trades and my losing trades. And that, you know, I'm still making money and my metrics look a lot better than if I were, say, trying to scalp or, you know, using much larger stops. So for me, it is about finding the area where the market is going to turn, because that's the area at which I can put on a low risk entry and potentially get into a massive move. So this is the picture perfect kind of expanded flat. That's exactly what this is here. ABC up for B, and then 5 waves down for C. And this is the one that just barely missed the area. So it didn't quite make it down to the upsloping lower median line on the 5-minute when using the higher low. So here, let's just go over this for a second. Because I use the higher low to find the target to get out of the trade. So then, you know, obviously I would have kept it there in real time, and we didn't quite make it down to that lower median line here. So I would have missed that one. But had I have used the low there, it's still off of it just a little bit. So even then, I probably wouldn't have taken this one. I don't think I did take it actually. So, and then you see the demand coming in here off the low. Pops below the previous low and rejects right back up on a huge amount of relative volume, over 400%, 460. And then it turns up. So we're probably about to call it a day here. All right, let's go to the next day. When will I make it available? Or will I? Yeah, I'll make it available, yeah. You guys will have all of this stuff here. Definitely by the webinar next month, but hopefully by the end of the month, this month. Yeah, it looks a lot nicer than it did, huh? I think. Still a little bit loud on the tick charts, but the signals are much cleaner. All right, so anyhow, at this high, we now have 5 waves up. maybe not yet, maybe a little bit higher. Yeah, I'm not trying to argue or anything. Everybody has their own style of trading and their own opinions and ideas of what's useful and what's not. But I know what's useful to me, and that's what I do. This is probably the area that we're going to run into, the trend line from high to high here, or the top of this channel, one or the other, or neither. Okay, that's the big buying climax here. Yeah, so that's it. That looks like that's it right there. It didn't quite make it to the 61.8, but you see the volume here? This is incredible. A huge amount of volume. Granted, it's in the middle of the night. Well, it's after the reopen, so it's 6:45, 7 p.m. So in reality, it's a very low amount of true volume, but compared to that time of day, that's a huge amount of volume per that time of day. So you get the huge, big, wide-ranging bar climax, but the volume is so high that it's also the highest volume per range, probably on the entire chart. And then the next, well, aside from that big selling climax that we had before this, to start this up move, the next bar is a narrow range churn bar. That's the 2-bar pattern that we always look for right there. I can't tell you how many times that's the major turning point or the turning point right before the final swing high. So a volume divergence would be to be knocked down or sideways and then go up and test that high on less volume. Ed is asking, how long have I been using median lines? 2008, I guess, 2008. But I tried all sorts of stuff. I mean, I started off with volume and market geometry, and then I went off into such ridiculous stuff I can't even tell you. And then I came back to market geometry and volume about 5 years ago, and then put all of this stuff together, because this is the only thing that I could actually prove that was useful. I couldn't prove anything else, literally anything. I couldn't prove anything else was useful. But this stuff I can prove very easily. So we need to go back to the 5th. Yeah, right here. Well, I guess we've seen everything now. All right, William, have a good one. Yeah, I'm just going to keep going a little bit longer, guys. You can come, or sorry, you can stay or leave, or, you know, whatever you want to do. I'm just going to mark up a couple of more trades here. So I'm just looking at this. So this is the typical volume divergence right here. Big buying climax, knock it sideways or down, and then drift a little bit higher. Test the high on lower volume. That's it. It's like one of the major things that we look for. And it's broken out of the top of the channel there. So that's a small a small throw over. And now the volume is picking up to the downside. So see, I wouldn't be looking for a short just yet, though. I would want to see a significant push to the downside first. And that doesn't happen until right here, but that's 1 o'clock in the morning. So let's get to 5. It's about 5:30 right there. All right. So this is about the first point that you could begin even considering a potential short. So if you are considering a short, what do? Well, you just connect the 2 previous highs together, right? Pretty simple. don't quite line up there. And then you connect the previous lows together as well. And this one is not lining up either, so I need to refresh these actually. All right, we'll make it through this eventually here. Okay, so we've had a retracement back up out of a massive extreme spike and an extreme churn bar, and then it's bought back up, finishing on a massive buying climax into that high. Excuse me, that's also the VWAP of the day. That's the volume weighted average price where that high occurred right here. So we don't really have anything yet. I mean, it's close, but not quite. And then we would have, yeah, it's already through that lower median line. So let's keep scrolling and see. All right, that's close. All right, that's the spot right there. So let's see, you've already got the one area that you need. Let's see if we don't have a median line coming in right there. Nope. It's probably going to be a larger area. I probably should have worked some of these out before we started, but I guess that would be cheating too. Yeah, you've got the kiss goodbye line here. It's pretty close. I'd say that's a hit of it. So you break out of the channel, you pull back to the underside of it. You did that once here and you've rejected. Now you've done it again, except this time you're back into the most obvious, you know, the two major swing highs to the left. And that's where you're at right here. And you have a buying climax on the 1 minute. You've got a weak, sorry, I can't say it's a weak anymore. It's just a normal climax on a major spike in the relative volume on the 5 minute. And then let's see what else you might have here. This one looks a little funny. You got a midline, but I don't typically like to treat that as an area. Not a major one anyway. And you've got a little bit of a throw over here. So I would attempt it for the sake of this example, because it does look like a triangle. So the fact that it's not breaking, you know, above the previous swing high, that would be in lockstep with a potential triangle for this wave high here. And then basically just looking for a break of the low. So let's see what happens. It looks kind of funny, but let's see. So if I took that, I would want to get down to the bottom of that channel, but that's probably less likely. So I'd be happy with making it to the median line and to this low, sorry, the trend line connecting the two lows together. So that would be where I would take the second target off, essentially right around this price, just on a break of the low, essentially. So we'll get in right in here, put the stop right here. Well, that's pretty much where my first target is. So I'll get out right there. Ooh, that's actually another trade setup there. Did I even get, yeah, I didn't even get the first target filled. But this is actually another hit of the area, and it's a better looking 5-minute bar. That's a huge, well, it's not massive, but it's a nice churn bar. It's pretty massive compared to the previous 8 or 9 bars, 7 or 8 bars. And it's right back into the area. And on the 2-minute, or sorry, the 1 minute, I'm used to using the 2-minute. On the 1 minute, we have a really nice extreme density, extreme climax. So it's a massive relative volume bar and a huge relative density bar. So a lot of supply coming in right there, and it's also the kiss goodbye line right here. So this was the last uptrend line, right? We broke out of it and we pulled back to it right where those two intersect. And that's a pretty nice looking spot there. So if I didn't take it here, then I'd be taking it right there for the sake of this back test. Oop, okay. That should have gotten me out. Yeah, okay. It was waiting for the bar to close. So, ooh, I missed it by like a tick right here. And then I got out of my second one there. And then it came down to the trend line connecting the lows together. So I'm going to go ahead and shut it down, guys. This is taking a lot longer to explain everything as I do it. It shouldn't take you this long to actually do a manual back test like this. They are time consuming, but really I don't know of anything better to help you get good at pattern recognition. That's what trading is all about. Unless you're, going for complete 100% mechanization, pattern recognition that's trading. I mean, that's what it's all about. And if you want to get good at trading, as opposed to getting lucky with putting together some set of fully mechanized sets of conditions, if you want to actually become a good trader, which entails managing risk, finding good entries, but obviously more importantly, finding great exits, then the best way for you to spend time and doing homework and whatnot is to do this right here, exactly what I'm doing. Going day by day, bar by bar, using at least 3 charts. If you're new to multiple time frame analysis and market geometry and volume, especially, maybe you want to focus on just 2 charts to get comfortable with it. But this is where it's at. I mean, this is the only way that I was able to improve my own reading of the market. It's not by sitting there watching the market live and taking random trades. It's by, after the market closes, going back day by day, bar by bar. Why did the market turn here? What were the reasons for putting in the high of the day right here or the low of the day right there? Why did the market make a retracement here? And volume, you'll find, is a big key to that, volume and market geometry. And then, of course, the price action, the actual waning of momentum into those highs and lows. This was a really beautiful swing low here. I should go over that real quick because that was just incredible. I'll do it without the median lines, but this one was just picture perfect here. You had everything but the perfect upsloping area. So I almost took it, Josh took it, but then actually I think he got out of it. But what all came together there? I got a chart of it somewhere. Let me just find the chart real quick because that one was pretty nice. Let's see. This is HIP chat. This is what we use for our trading room. Yeah, that's it right there. So this was the low that you're seeing right here. right there. You see that really high volume swing low? This is a nice little 5-wave move down to complete a big A, B, C. This is what it looked like on the tick chart. Is that the same low? No, sorry. That's the low before. This is the low before the next low. That low right here was this one, okay? That one lined up pretty well as well, but this was the really pretty one. That's the next one, sorry. This is where it all came together. Right there. This is what makes market geometry so incredible. And it's just obvious after you start working with it for so long. It just kind of blows you away. You see this stuff happen over and over and over. And I don't know, to say that the markets are random, I think is a joke. It's a total joke to me. Look at the perfect C wave. Right into that confluence of areas there. C is 100% A. 3 and 5 are 100% of 1. And 5 is 61/8 of 1 through 3. They're all lining up right there. It's just incredible. And you have what? What do you have? What have I been saying all day, all afternoon here? The 2-bar pattern, that big selling climax followed by a narrow range churn bar. That's what that is right there. Except this one is almost 1,000%. It's pretty incredible. So anyway, that's what we look for. And this is just a small taste of doing a manual backtest. We'll do, for all of you guys that have bought or will buy by the end of the weekend, we'll do probably about a 2-hour training session on next Wednesday and go over this stuff a bit more thoroughly, let you guys ask some questions, and give you guys a chance to play with it for a little bit and get used to it. So let me post the link one more time here. All right, I just posted the link. I see it, thanks Josh. So it's, yeah, okay, it's doing a triangle. So we should get another wave up, hopefully. All right, good. All right, good deal, Bill. Yeah, I think you'll like it. I like it a lot. And then with the next update, it'll be even easier to use to do the bar by bar stuff for the second target. So that next update is going to be really perfect for the way that we're doing the type of backtesting that we're doing. Peter, you mentioned for a newcomer using 2 charts. Which chart do you use for the trend direction? So the trend direction is so many different ways that you can do that, but as far as using a moving average or something like that, that's not good. Typically, I'm using market structure, wave count, and basically the direction of the largest channel. So for instance, let's say you're using, let's just go to the current data. Let's just say you're using a 5-minute and maybe, well, let's just use a 5 and a 1, for example. If that's what you're going to do, then you're going to be taking pretty small corrections, right? You don't want to be trying to trade counter trend on both of your charts. You want to be trading with the trend on the higher time frame that you're using depending on how many time frames that you are using. That's why probably the way that I trade is more complicated for a lot of people, because the setup that I'm taking is a function of how many bars make up the correction on each chart. And whichever chart the correction takes up between, say, 35, let's say about 40 to 110 bars. That is the chart that I name, whatever you want to name it, the operative time frame, for instance. That's the chart that the correction is occurring on. So here, this is a nice little correction today that broke to a new high, and that would be your exit right there. Why would that be your exit? Well, because you had 5 waves into the high and you broke the previous high. But here, this would be your correction, and it's making up 50 bars. So this would be definitely a setup that I would allow, but I would say that the setup is occurring on the 5-minute chart. The operative time frame for that setup is the 5-minute chart. Excuse me. And then I have a set of rules for the subsequently faster time frames. So if all you have is 2 time frames, well, then you want your setups to occur on the larger chart, and you want to confirm with your smaller chart. So if this is your larger chart, this is your 5-minute chart, then you're looking for corrections between, if you're only going to use 2 charts, I would say between maybe 20 and 100 bars, something like that. But as far as direction is concerned, you want to try to identify which direction is the last impulse move in what direction is the last impulse move. And up to this point, what would you say? If you're sitting right here, this is the only chart that you have, this is your higher time frame. Well, obviously you would say the move is up, right? The trend is up. If you want some kind of an exact rule for trend, when you start getting into creating rules for all these different things, you start mechanizing your rules for your trend, your rules for let's say a bunch of different rules based on oscillators or moving averages or stuff like that. That's based off of equations using price bars. The more types of those rules that you add, the worse the performance gets. So when it comes to identifying some kind of a rule, using some kind of a rule for trend, I don't really have a mechanical rule for that. I try to identify the market structure. A guy in the room that trades with us, Chris, he's really good at market geometry, but he has his own little nuances, and he'll use, for instance, the channels and parallels, and this is maybe getting a little too complex and maybe revealing too much, but here, you see how we didn't make it to the top of the broken channel? So he might say, well, the trend is weakening now. We're in a weaker position because we're not actually making it to the top of the channel, so it might be stepping down in the channel. So there's a number of different things you can look at for trend, but as far as mechanizing, I wouldn't try to do that. I would just focus on identifying the impulse. You can learn the basics of Elliott wave and just take away the difference between impulse moves and corrections. You don't have to master Elliott wave, you don't have to believe it, but if you can get an understanding of the difference between impulse waves and corrections and have some kind of understanding as to what corrections generally look like, then you can make some, pretty decent improvement just by understanding those couple of things. So here, an impulse move, what is an impulse move? We're looking at waves that are typically not overlapping. And the larger part of the move is in the direction of the impulse. So the larger part of the move is up. See, this push up is much longer than the sideways overlapping down move. Again, we got a long push up. It's much longer than the overlapping sideways and down move. You see, get another long push up. It's much longer than the overlapping sideways down move, right? And we're consistently making new highs, new lows. It's another way that people look at trend, highs and lows. That can be misleading though. And then you're looking for the next big correction out of the high to find the end of for the next push up. And that's what we're doing here. So we're trying to get into a long trade. We're looking for a correction back down. So let's say, I'm not going to try to, well, let me just see if I can figure out the area that we're at. Oops. So, well, you've at least got a break of the channel right into the median line here. It's not upsloping, but maybe I've got an upsloping median line here. Nah, not really. I'm not going to worry about trying to find the upsloping line, but here you're looking for, you've identified the impulse up. You're looking for the correction back down. Quite often that correction will trace out a channel. Not always, especially not if it's a really sharp zigzag with very minimal pullbacks, or if it's an expanded flat. But if it's a double three or a flat or a zigzag with a nice retracement like this is, 5 waves down, 3 waves up, 5 waves down, then it will trace out a channel most often. Okay. It may break out of the bottom of that channel a little bit, but it can't go through the bottom of the median line, the lower median line. If it does that, then you're changing direction. You're in a new impulse to the downside. But here we find support on that. So we've got the area on the 5 minute. And what do you use the 1 minute for? You use the 1 minute to confirm that area. And what do you have right here? Not that little 2-bar pattern. A big, massive selling climax followed by a narrow range, high volume, high density churn bar. That is demand coming in. That's what that is right there. That is a sign of demand coming in. If you're not using volume, then how would you know that? In order to know that just by looking at price, you would have to have had some kind of experience with volume already. I wouldn't necessarily have to have the volume on the chart to know that a huge amount of demand is coming in there. If I'm watching it in real time and I see a big selling climax, and then I see that price, jerking back and forth really quickly, then yeah, I have an idea that volume is coming in there. But I know from experience now that that is a sure sign of demand coming in. So that's what you want to do. You want to use the larger chart to identify your impulse moves and find your corrections. That's why I use so many charts, because there's so many different corrections making up, all sorts of different patterns and number of bars on every single different chart. So we have, a daily, a 240 minute, an hourly, a 20 minute, 5 minute tick charts. So depending on the number of bars making up that correction, then that dictates the set of rules that I would use for the subsequently faster charts. Let's see, this is the last little channel right there. So you've got your up, well, it's not exactly upsloping because you've broken out of the bottom of it here, but you've run right into the median line. You've got a larger channel that it's breaking out of the bottom of, but it's breaking out of the bottom of that right into what? This channel here, to the tick to the median line. You throw over the channel line right into the median line on a huge selling climax followed by a narrow range churn bar. And it's actually divergence, but it's just barely divergence. If I change this to a 2-minute, then it'll be divergence there. The relative volume, yeah, you can put this on Forex. Ticks, number of ticks, they say is, what was the study they did? I think it's like 93% correlated to volume. Just the sheer number of transactions. It's 93% correlation to volume, something like that. The study I think the CME did, or maybe it was IB that did it. You can find the information on that somewhere, but ticks were correlated 93%, something like that, of volume. So yes, you can use this on Forex. Let me just open one up and show you. What do you want to look at? What Forex do you look at? I got to connect to data. I'll do that and then we'll close it down for the night. It's already getting kind of 3 hours. Sheesh. There's the relative volume. On the Forex, the Aussie. So it's using ticks instead of volume, but ticks is the best you can do with Forex. And it's still better than nothing. And it's over 90% correlated to volume. So you still get some pretty amazing signals. This is the volume divergence. That's the main deal right there. Spike in volume, sideways to down, and a perfect ABC as a matter of fact. And then back up to test the previous high. That's one of the signals. Here you've got a big gap down. That's a huge amount of, I guess we should say, ticks that came in there. It auto scales to get rid of these massive bars when they occur. Yeah. If you look on our website, if you're curious about the volume or anything, or any of the other tools, the toolbar or the divergence, the volume and the toolbar have not been updated on the website. So what you would see would be the old version, which is about to be replaced. If you're looking for information on that. Anybody? So there's another extreme churn bar at the high, this red one. It's another normal churn bar at the low. There's some churn here, knocks it sideways a little bit. You got the 2-bar pattern there. Buying climax followed by the churn bar, knocks it sideways. Another little 2-bar pattern there, knocks it sideways. And then the little buying climax. It's an extreme spike in the volume at the high. A couple of churn bars, but the final one is the big one that closes off at the high. So yeah, it still works for Forex. It's maybe just not quite as pretty as it would be with normal volume. But then you can look at the futures too. If I were trading Forex, I would use, well, I guess depending on the Forex market that you're looking at, but I would use one of the futures as well. But I wouldn't trade Forex anyway. I don't like the spreads, the slippage. It's just a lot of, well, I guess FXCM getting busted kind of confirmed all of my old suspicions that the brokers were trading against your positions, and I guess they confirmed that. didn't they? They busted FXCM anyway. So I think that is, I think we'll call it a day right there. But if you're curious about the relative volume or the toolbar or the divergence, all of our products are listed here on the products page. So this is all getting kind of revamped now that we're getting close to finishing all of this development we've been doing. This will all be getting updated here soon. And if you're interested in Elliott Wave, this is something I use extensively. I know a lot of people, evidently a lot of people don't like it, I guess, but I find it incredibly useful, Elliott Wave theory. And we've got some discounts on what I think is the best place to learn Elliott Wave from. And that's from, you know, the guy that rewrote the book and improved upon it, and that's Robert Prechter. So you can get, I think, like a 50% discount on all of these different subscriptions. These two over here are intraday, which are pretty nice to see, you know, professional analysis. The Euro USD, the yen, NYMEX, and natural gas. They have a few others too, though. You can pretty much pick any market that you want. But if you're interested in learning Elliott Wave, this is about the most valuable resource. Basically, you mark up your charts and then you follow along with a professional's analysis and then correct your mistakes, and that's how you learn. So if there aren't any more questions, I will go ahead and call it a night, guys. I'm sure that was probably longer than it needed to be, but at any rate, if you have any questions, feel free to write in to support@TradeThePlan.com. And again, this is the page for the backtester, the manual backtester. All right, everybody, have a great night. I'll talk to you guys in the trading room tomorrow morning. All right, bye, everyone.